Dividends for passive income is absolutely amazing, but most dividend paying companies and ETFs are paying out dividends every quarter, which means that you're only getting paid every third month. But if you want to be consistently receiving dividends every single month, then I've found the perfect stocks for your portfolio. The 3 dividend stocks that I'm about to give you guys are paying out dividends at different times. The first one is paying out dividends in January and every third month. The second one is paying out dividends in February and every third month. And the last one is paying out dividends in March and every third month. In that way, you're basically getting paid every single month. Not only will you be getting dividends every single month, but the stocks on my list are also blue chip stocks that right now are trading at really good values. If you like today's video, then don't forget to smash the like button and subscribe to my channel for more weekly videos just like this one. So the first stock on my list is JPMorgan, ticker symbol JPM. JPMorgan is the largest US-based bank when looking at their total assets, and their total assets is worth $3.7 trillion. On looking at the stock chart for JPMorgan, then we basically see that JPMorgan have increased by almost 20% year to date, which makes them one of the best performing banks. And they currently have a market cap of $406 billion. Within the banking sector, a lot of things has happened recently with the high inflation, the really high interest rates, and that have resulted in several banks going bankrupt. And that includes First Republic, that was recently taken over by JPMorgan for a really low price of only $2.2 billion. JPMorgan is focusing on 4 different segments of the total banking market, and that is consumer banking, investment banking, commercial banking, and asset management. Even though the economy right now is in a bit of a weird spot, with the Fed having increased the interest rate for 14 consecutive periods, then are the banks actually performing very well under these circumstances. The reason is that increasing the interest rate does have an impact on what is called NII, or the net interest income. And that is basically the difference between the interest rate that they are earning and the interest rate that they are paying out. And that could, for example, be on a savings account. The interest rates on the loans that the bank is providing to their customers are increasing at a much faster pace than the interest rates on, for example, their savings account. And that means that the NII is increasing, and thus is the revenue for all of the banks increasing as well. But in terms of the dividends, then is JPMorgan currently paying $4 per share, which gives them a dividend yield just below 3%. The bank has a payout ratio that is below 30, and that is really good, because a low payout ratio means that the bank can easily sustain or even increase the dividend in the future. Over the last 5 years, the company has increased their dividend by 13%, and that makes them a really good dividend growth stock. They have also increased their dividends for the last 8 years in a row. When looking at the payout history for JPMorgan, then we can basically see that they are paying out dividends in January and every third month. But you should of course never buy a stock just based on the dividend payments. So let's have a look on the current valuation for JPMorgan. They have an earnings per share of roughly 14 and a PE ratio of only 9. So that essentially means that the largest bank in the US is currently trading at a PE of single digit. And that is really good for a company of this quality. So overall, then is the current value for JPMorgan looking really interesting for us as investors right now. The second stock on my list is Starbucks, ticker symbol SBUX. This is a company that the majority of us knows about, and you've most likely also bought some of their products, as they do have a really strong worldwide brand. They have made coffee more than just a cup of coffee. They have basically turned coffee into a luxury product, and there are people that love buying Starbucks, and that does it every single day. The customer loyalty in Starbucks is extremely high, and Starbucks currently have a market value of $112 billion, and the share price have actually increased by 27% over the last 12 months. But recently the share price has stolen out, and they have actually fallen by 2% year to date. The reason why Starbucks has fallen year to date is actually due to the performance of Starbucks. The largest segment for Starbucks is the US, and the US performed as expected. But the second largest segment for Starbucks is China, and China did not perform as expected. When the company released their second quarter sales numbers, we saw that North America is up by 12%, but China is only up by 3%. The investors had expected a lot more growth in China, as China just eased all of their COVID-19 restrictions. And all of that growth that the investors had expected in China was already priced into the stock. The company is, however, still very focused on increasing their sales in China. And they are expected to open a new store every 9 hours, which is completely insane to think about. But let's have a look at their dividends. The current dividend yield is 2.12%, and they have a 5-year growth rate of 12.5%. And they have increased their dividend yield for 12 consecutive years. And when we're looking at the dividend history, well, then we basically see that they're paying dividends in February and every 3rd month. So now you have JPMorgan paying out dividend in January and every 3rd month, and Starbucks paying out in February and every 3rd month. But let's have a look at the current valuation for Starbucks. They currently have an earnings per share of 3.5, and that equals a price earnings ratio of almost 29. Analysts are expecting really high growth rates going forward for Starbucks, and that combined with a really strong brand is basically a good recipe for success. I don't see the share price here in 2023 as being too high. The share price has stagnated and even fallen year to date, and that could indicate that right now might not be a bad time to buy. The third and last stock on my list is Pfizer, ticker symbol PFE. You most likely know about this company, and that is because it is a top quality medicine company that over the last couple of years has been a lot in the news, and that is because they developed a really good COVID-19 vaccine. Pfizer currently have a market value of $205 billion, and during the last year, the share price has plummeted almost 30%. One of the main reasons as to why Pfizer has fallen that much in value is because of their revenue decline. They have basically declined a lot in revenue because they're basically not selling any COVID-19 vaccines anymore. They did, of course, have a really high revenue during the COVID-19 pandemic, and that was basically because they sold so many vaccines. So it is only natural that it falls back to the previous levels. In addition to this, then is the company also facing a patent cliff, which is actually very normal within this industry. However, it does create uncertainty, and investors does definitely not like uncertainty. The company does expect to increase its revenue back to the pandemic level, as they are in the process of creating a flu and COVID-19 vaccine that will basically be a combo shot. In addition, then does the company have a really strong pipeline of drugs that are expected to be rolling out in 2024, and these will offset some of the patent cliffs that they're facing right now. One of the drugs is focusing on RSV, and there are really high earnings expectations for this one. Pfizer has a really strong cash flow, and it is actually the highest paying dividend company on the list today. And they currently have a dividend yield of 4.5% and a low payout ratio of only 26, which is really good for them, as it means that they're able to sustain or even increase the dividend in the future. Over the last 5 years, the company has increased the dividend by 5.3%, and they have consistently been increasing their dividends for 12 years in a row. When looking at the dividend history, we see that Pfizer is paying out dividends in March and every 3rd month. So now we actually receive dividends from JPMorgan in January and every 3rd month. In February, we receive from Starbucks, and in March, we receive from Pfizer. In that way, you are basically getting paid with dividends every single month of the entire year. And in terms of the valuation, then is Pfizer actually looking really good. They currently have an EPS of 3.94 and a PE of 11. With all the things in their pipeline, their really strong brand, and their strong existing products, then I have really high expectations for Pfizer. And I have actually recently bought more shares in Pfizer. So there you have it, the 3 stocks that are going to secure a monthly dividend payment and thereby increase your cash flow every single month. Not only are they paying out great dividends, but they are also trading at great values right now. I hope that you enjoyed today's video, and if you did, then don't forget to smash the like button and subscribe for more weekly videos. See you in the next one.